Hello everyone, my name is Nudge and I welcome you to my IFRS tax accounting course. In this course, I'm going to teach you how to prepare the income tax disclosures in a set of IFRS based financial statements. To fully benefit from this course, it's important you're an accountant and you have a decent understanding of how corporate tax works in any country of the world. My experience is slightly based on the Nigerian and the UK tax environment. And that's why many of the illustrations I'm going to use in this course will be drawn from these two territories. But never mind, if experience is from a different country, you will still find this course pretty useful. And so, as a starting point, I'm going to go through an illustration of a hypothetical company which I've called Nudge Limited. And this example is going to help us to appreciate the scope of this course. And so you can see on the screen that we've got 7 assumptions. So the first assumption is that Nudge Limited is a UK company that started operations in 2023. The first financial year ran throughout 2023 from Jan to December. The accounts were issued at the end of January 2024. Startup capital is £1 million. Nudge Limited has no subsidiaries. Corporation tax rate in the UK is 25%. And as of the end of 2023, no taxes have been paid. So I'm going to show you different aspects of the financial statements to demonstrate this illustration. So the first is your profit and loss account, and I know some people call it the income statement, but I just choose to use the traditional nomenclature. So you can see your revenue of £2 million. Expenses of £1.5 million, profit before tax of 500k, income tax charge and income tax expense of 125k, and your profit after tax of 375k. This course is, it's an income tax accounting course, and so the focus here is the row I highlighted in yellow, which is your income tax expense. So what I'm trying to do in this course is to explain how to determine your income tax expense, and not just the income tax expense, every other tax number, tax disclosures within the account, within the financial statement that is connected to this number. That's what I'm trying to teach. Teach you how to determine this number and every other number in the account that have a direct relationship with this number. But for now, it's okay to keep the 125k in your head, and also note that there's a note 1 to this number. So you can see on the third column, I put a note 1 there. We'll get to that point. So the next one we will look at, the balance sheet. There's several assets, there's several liabilities here, and you've got the share capital and retained earnings. Again, here the focus here is on tax, and the only tax number here is the current tax liabilities. You can see that it's a balance of 125k. If you still remember your double entry, when you have an expense, what you do is you debit your expense and of course credit something else in your balance sheet. In this case, because the tax has not been paid, we still owe the tax, so you need to credit the liability. So which is why you have your expense in the P&L here, and you have your liability in the balance sheet here, which hasn't been paid. Then let's go to the notes to the accounts to see what it looks like. So your first note to the account, note 1. Note 1 says you've got a total expense, income tax expense of 125k. There are 2 components to it. There's a current tax of 125k and there's deferred tax of 0. At the later part of this, because I'm going to explain what the current tax is, what deferred tax is. But for now, it's okay to understand, to know that your income tax expense usually has 2 components, current and deferred tax. At a later point, I will explain what these 2 mean. Note 2. Remember that the note 2 is connected to the balance sheets in this example. You can see it now. In this case, note 2 is the note to current tax liabilities. Remember, in the assumption, this company started in 2023. So clearly, it could not have owed any taxes as of the beginning of the year, and that's why the opening balance is 0. The opening liability is 0. There was a charge for the year of 125k, which you can see there. You can see that there are no payments made and that's why your liability is still the same. Assuming some payments were made, the liability will have been smaller than 125k. But in this case, there are no liability, no payments, so your liability is exactly equal to the charge for the year. And that takes me to the final aspect of this video, which is your note 3, and I've called that the effective tax rate reconciliation. So what is note 6 to do is to explain the different factors contributing to the size of your income tax expense. And if you pick a random person who is not familiar with how tax accounting work, what they will do is they will expect that your tax expense should be equal to your profit before tax multiplied by tax rate. But this is almost never the same. And if you want to understand why it's not the same, you need to go and look through the notes that talks about the effective tax rate reconciliation. That note explains why your tax expense is not the same as profit times tax rate. But in this example, I have purposely kept it simple. I have made the income tax expense to be exactly equal to tax rate times profit before tax, which is 500k times 25 pounds, 25%, and that's why you have a tax expense of 125k. But what I've also done is to mention two common factors that typically contribute to the size of tax expense, which is the effect of non-deductibles and the effect of taxable income, of non-taxable income. But again, for simplicity, I kept them as 0. At a later point of this course, I will build in those complexities in piecemeal. But just so to keep it simple is to say, these are the broad areas we are going to try to cover in this course. So in the next video that will follow this, what I'm going to try to do is to explain what income tax is. What do you need to look at to be able to determine whether this tax is an income tax or not? Because once we're able to determine what an income tax is, we can then account for it through this mechanism. Because when a tax is an income tax, you need to put that tax in the tax line, and the tax line is the line between your profit before tax and profit after tax. If a tax is not an income tax, you don't put it on this line. You account for it above the profit before tax line. So this course is entirely focused on income tax, and in the next video I will be explaining how to determine an income tax, what makes up an income tax, because that is what we intend to focus on in the other aspects of this course. So I enjoy you to watch out for my next video, and thank you for listening.